Yeah. Good evening, class.
Good evening, sir.
Okay. Yeah, welcome to Taxation class for skills. And you are also welcome to Equity Professional. So my name is Isaka Idris Tunde, Mr. Isaka Idris Tunde. So I'm one of the lecturers that will take you taxation for skills level. So today being the first lecture day, we are going to look at Introduction to Taxation. We are going to look at Introduction to Taxation. We are going to introduce objective of taxation, type of taxation, principles of taxation, challenges or problems encountered by government while collecting tax. We also discussed that in this class. So you are welcome once again. So my colleague is going to be around by next week. His name is Mr. Wasil. So we can start. I will start with what is tax, definition of tax. According to my material, tax is a compulsory levy imposed by government on its citizens for economic growth and development. What this means is that tax is a levy. Levy means an imposition, something that was imposed. So tax is a compulsory levy imposed by government on its citizens for economic growth and development. What does that mean is that it is government that collects tax. And it also means every citizen that earn income, that receive income, is compulsory for them to pay tax so far as you are earning income. So tax is a compulsory levy imposed by government on its citizens for economic growth and development. Why government collect tax is for them to improve the country economic growth and development, to create more growth and development in the country. That is one of the reasons why government collect tax. So apart from definition of tax, we have another definition called taxation. What is taxation? Taxation is a system or method used by government. Taxation is a system or method used by government in collecting tax from time to time. The system or method used by government in collecting tax from time to time, that is taxation. Is different from tax. How does government collect tax is what taxation is talking about. What method does government use to collect tax is what taxation is talking about. Objective of taxation. Let's look at objective of taxation, or reason why government collect tax, or purpose of taxation. It's the same thing. You can be asked, explain the objective of taxation, or discuss purpose of taxation, or explain the reason why government collect tax. Number one objective of taxation is to generate revenue for government. To generate what? Revenue. So one of the objectives of taxation is to generate revenue for government, to generate revenue so that government can provide the need for the citizen. Another objective of taxation is redistribution of income and wealth. Redistribution of income and wealth. This one simply means government want to use tax to bridge the gap between the high income earner and the low income earner. By collecting tax from the higher income earner, and they will use the tax to develop where the lower income earner is residing, so that the gap between the rich and the poor is going to reduce to the barest minimum. So redistribution of income and wealth simply means one of the reasons why government collect tax is that those who are earning more income, they pay more tax than those who are earning lower income. So the tax that government collect from those who are earning higher income, they are using it to develop the area where the lower income is residing. They use it to provide social service to the lower income. They use it to sponsor the lower income to education, for free education. They use it to provide free health care service to the lower income. Another objective of taxation is management of economy. Government collect tax. One of the reasons for that is to use the tax to manage the economy. Tax is one of the fiscal policy of government. We have monetary policy, we have fiscal policy. One of the tools of fiscal policy is tax. Government can use tax to control inflation. Government can use tax to control employment. Government can use tax for price control system. If government want to ensure that the price of goods and services is reduced, they will reduce the rate of tax so that the manufacturer can reduce the price of goods and services. Management of economy. Government sometimes they can subsidize the price of goods and services. Management of economy. So one of the objectives of taxation is management of the economy. Another objective of taxation is harmonization of economic objective. Harmonization of what? Economic objective. Government collect tax so that the national economic objective can be achieved, so that government can have interrelationship between one another, so that government can relate with other governments in another countries. That is another objective of taxation. Another objective of taxation is to protect domestic industry. Another name for domestic industry means local industry or infant industry. Government can collect tax by using the tax to protect domestic industry. Domestic industry are those industries that are located within the country. Small industry owned by the citizens of the country. They are the indigenous company. Government can protect this domestic industry against the foreign industry. How? Most of the foreign industry, they are the ones that import product to Nigeria. Government can collect tax. Government will impose more import duties on those imported products. And government will now create enabling environment to the local industry. So that by putting more import duties on those imported goods, it will discourage people from consuming the imported product. People will not have option than using the one manufacturer within the country. By virtue of that, it's going to increase the business activities of the domestic industries. It's going to create more value within the country rather than importation. So the objective, one of the objectives of taxation is to protect domestic industry. Aside from this objective I mentioned, we have another objective which is not in my material here, is to discourage consumption of harmful goods. Another objective of taxation is to discourage what? Consumption of harmful goods. There are some goods that are harmful to our health. And because government is realizing a lot of revenue, a lot of tax from such kind of good, from the producer of such kind of good, government cannot discourage people. Government cannot ban the good. They will implement a policy that can be used to discourage the consumption of the good. Example of such good is alcohol, tobacco, cigarettes. Government can discourage it. How can government discourage it? Because it's very dangerous to our health. Government can discourage it by imposing more tax on such kind of good, so that people that are using the good, they will not afford to buy the good. It will discourage them from consuming it. Take for instance now, assuming a pack of cigarettes is going for about 10,000 naira. It will reduce the rate of smoking. Presently now, a pack of cigarettes is about 500 naira, 400, 300. So some people can smoke 5 packets in a day. But when they are selling one packet of cigarette 10,000, those who are smoking 5 packets, it will discourage them from smoking more. So one of the objectives of taxation is to discourage consumption of harmful goods. Another objective of taxation that is not in this material is to protect local currency or preservation of local currency. Government can use tax to protect our local currency against foreign currency, to ensure that government can use tax to ensure that our local currency have more value than the foreign currency. How does that happen? Government will say that any transaction that we pay through foreign currency, there will be more tax on it. There will be a special tax on foreign currency transaction. By doing this, it will discourage people from trading through foreign currency. It will discourage people buying goods on foreign currency. They will prefer to buy the one of local currency. By virtue of that, our local currency will have more value against the foreign currency. So to protect or preserve local currency is one of the objectives of taxation. So those are the objectives of taxation. Let me repeat the objective again. Let me summarize them. Number one of the objective of taxation is to generate revenue for government. To generate revenue for government. Number two, to redistribute income and wealth. Redistribution of income and wealth. Number three, management of the economy. Number four, harmonization of economic objective. Number five objective of taxation, to protect domestic industry. While number six is to discourage consumption of harmful goods. And we have number seven is to preserve local currency. So those are the objectives of taxation. Now, let's move to sources of tax law. Sources of tax law. Where do we get law relating to tax? Number one sources of tax law and primary sources of tax law is the Constitution. Number one sources of tax law, which is the primary sources of tax law, is the Constitution. The Constitution of 1999 of Nigeria, Section 3 of that, stated clearly the taxes and levies, the approved taxes and levy that can be collected by each tiers of government. Section 3 of the 1999 Constitution states clearly the approved taxes and levy that can be collected by each tiers of government. What we mean by that is what kind of tax federal government collected, what kind of tax state government collected, what kind of tax local government collected. It has been stated in the Constitution of 1999. Another sources of tax law is called statutes law. Some people refer it as statutory law. They are the law enacted by the National Assembly. All those laws that pass through the National Assembly. Example of such law: Personal Income Tax Act, Company Income Tax Act, Value Added Tax Act, Capital Gain Tax Act, Finance Act. The recent one that they are deliberating on now, that they are yet to approve it, Tax Reform Act. All these are statutory law because it passed through the legislative arms of government, and they are specifically designed for the purpose of taxation. Another sources of tax law is called case law. Other sources of tax law is called case law. Case law, they are the law arises from tax disputes between the taxpayer and the tax authority. When a final judgment is passed by the judiciary, and that judgment has now become a judicial precedent, so that other company or other taxpayer can emulate it as part of point of reference. Example of case law: Shell Petroleum Company, Shell Petroleum Development Company versus FRS. It's a case law. When Shell Petroleum Development Company took FRS to court, at the end of the day, when they make the final judgment, some other upstream petroleum company used it as a point of reference, as a judicial precedent, because it has become a law. Another one, budget speech. Budget what? Speech. It's a sources of tax law. Budget speech too is a sources of tax law. Budget speech means the presidential state speech at the time that the budget want to be, when president want to sign budget into law, president can make some speech at that point in time. Such kind of speech can use as a point of reference in tax. It's one of the sources of tax law. Through budget speech, government president can set the increase some, they are planning to introduce some new type of tax. But when a budget speech is made by the president as regards to tax issue, such speech is not legal binding unless it has a legislative backing. But when we are in the military era, when there is no legislation, budget speech become a law. I remember in 1993, VAT was introduced as a result of budget speech of the then head of state. Before they introduced VAT through budget speech in 1993, the then head of state want to sign budget into law. He now said there is a new VAT, there is a new tax now that relate to consumption. That tax is called value added tax and is going to commence immediately. It is after the budget speech of the president and they have started collecting tax. It is after that they introduced value added tax act. Another sources of tax law is called customary law. Customary law. What do we mean by customary law? Customary law, they are the olden days law. Tax has been in existence for over thousands of years. Tax has been in existence for over thousands of years. Tax is not just a new topic. It has been in existence for more than thousands of years. So in the olden days too, they normally collect tax. Even looking at religious slavery, if you look at it in the angle of religion, Islamic religion talk about tax, Christian religion talk about tax. In some area, give Caesar to what belong to Caesar. It's talking about tax. In Islam too, when we talk about zakat, it's talking about tax. Before the emergency of religion in Nigeria, the traditional worship too, the traditional rulers too, they have mentioned the issue of tax. In Southwest, they call it Ishakole. The traditional ruler have been collecting tax before we have this modern tax system that we have, that we are using now. Our traditional ruler, they have been collecting tax. So tax has been existent for more than thousands of years. So customary law has to deal with olden days law. Those are the sources of taxation. Now, let's look at Let's look at classification of taxation. Let's look at classification of taxation. How do we classify tax? Classification of taxation. How do we classify tax? Number one classification that we have is classification according to tax rates. Classification according to what? Tax rates. Under the classification according to tax rate, we have three types of tax. We have progressive tax, we have regressive tax, and we have proportional tax. Progressive tax, regressive tax, and proportional tax. What do we understand by progressive tax? Progressive tax is a tax system where the tax rate increase as the income level increases. In progressive tax, as your income is increasing, the tax rate that you are going to pay on such income will also increase. Example of progressive tax. The current personal income tax table that we have is example of progressive tax. Under the personal income tax, if you want to compute personal income tax payee for an employee, look at the table that we are using. First 300,000 is going to be taxed at 7%. Second 300,000 is going to be taxed at 11%. We have next 500,000 is going to be taxed at 15%. Next 500,000 is going to be taxed at 19%. Over 1.6 is going to be taxed at 21%. And above 3.6, 3.2, that one will be taxed at 24%. What do we tend to achieve from this table? What we can see from this table is that as the income is increasing, the tax rate too is going up. Is going up. That means it's progressive. That means it's progressive. As the income is going up, the tax rate too is going up. Regressive tax system. Another type of tax under tax rate. Regressive tax. Regressive tax is an opposite to progressive tax. In regressive tax, this is a tax system where the tax rate decreases as the income increases. In regressive, as your income is going up, your tax rate is going down. As the income is going up, your tax rate is going down. That is regressive. As the income is going up, tax rate is going down. That is regressive. Under regressive, it is a system where the tax rate decreases as the income level increases. That means regressive tax favor the rich more than the poor, but progressive tax favor the poor more than the rich. Another type of tax under classification according to tax rate, proportional tax. Proportional tax. Proportional tax. A proportional tax is a tax system where the tax rate remains the same despite changes in income level. The tax rate remains the same despite changes in income level. What does that mean? It means your tax rate will remain the same. Either your income is going up or your income is coming down. The tax rate still remain the same. Example of proportional tax. Value-added tax is an example of proportional tax. Value-added tax is an example of proportional tax. So it's an example of proportional tax. That is classification according to tax rates. We are under classification of tax. We have classified tax according to tax rate. If you want to classify tax according to tax rate, there are three types of tax under tax rate, under classification according to tax rate: progressive tax, regressive tax, and proportional tax. And as I've explained them one by one. Do we have any questions so far? Hello? Do we have any question?
No, sir.
Okay. Now, let's go to another classification. Classification according to incidence. Classification according to incidence. Under incidence, there are two types of tax: direct tax and indirect tax. Under incidence, there are two types of tax: direct tax and what? Indirect tax. Direct tax, they are the taxes imposed on income and profit derived by company, individual. Direct tax, those are the taxes imposed on income. But indirect tax, they are those taxes imposed on goods and services. Direct tax, they are taxes imposed on income derived by individual, company, income or profit derived by individual and company. But indirect tax, they are the tax imposed on goods and services. Now, let's talk more on direct tax. We have different type of direct tax. Direct tax can be, we can have like 7 types of direct tax. Number 1 type of direct tax is personal income tax. Personal income tax. Personal income tax is a tax income derived individual, trader, trustee, it is otherwise as you earn. Or collected by of tax is collected.
Sir, I cannot hear you clearly. I think your network. We cannot hear you clearly, sir.
Okay. Income tax. Taxes on income derived by individual, trust, partnership, sole proprietorship, and community. Personal income tax is otherwise called pay as you earn, payee. Like me and you, every month from our salary, a personal income tax is deducted before they will pay us our salary as an employee. And personal income tax is administered by or is collected by State Board of Internal Revenue Service. It is state government that collect personal income tax, not federal government. So the list of taxpayers that pay personal income tax, they are employee, individual, sole proprietorship, partnership, community, trustee. Those are the list of taxable persons under personal income tax. And they impose it on income derived by them. For employee, from which income that they will impose personal income tax? From the, if you look at it in the angle of employee, what type of income that they will pay personal income tax from? From their salaries and what?
And wages.
Right? And wages. You know, their salaries and wages can be break down into different heads. We have basic salary, we have housing allowance, we have transport allowance, we have utility allowance, meal allowance, 13-month bonus. Summation of them together is called gross salary. It's from the gross salary employee will pay his personal income tax after they have removed some relief approved by the tax law. For sole proprietorship, somebody that is not earning salary doing his business, from what type of income is going to pay his personal income tax?
Profit, from his profit.
From his profit. At the end of the year, that person will do his account. If he make profit, he's expected to pay personal income tax. So, personal income tax. Now, let's go to another type of tax. We are under, so let's go to another type of tax under direct tax. Company income tax. Company income tax. Company income tax is a tax imposed on profit derived by company engaged in commercial business transaction. It is imposed on profit derived by every company engaged in what? Commercial business transaction. Every limited company, either private limited or public limited, they are expected to pay company income tax. And company income tax is computed on the adjusted profit after provision for capital allowance. Company income tax is computed on the adjusted profit after the relief of capital allowance. What is the rate of company income tax? Who can tell me the rate of company income tax? According to Finance Act 2020, company income tax rate depends on the turnover. If a company has a turnover that falls between 0 to 25 million, Such kind of company is a small company. They are exempted from paying company income tax. That means their company income tax rate is 0%. But if a company turnover range from more than 25 million to 100 million, such kind of company is a medium scale enterprise and they are expected to pay company income tax rate of 20%. If a company turnover is more than 100 million, such kind of company is a large company and they are expected to pay company income tax of 30%. That is on company income tax. Another type of direct tax that we have is called capital gain tax. Capital gain tax. Another type of direct tax that we have is called capital gain tax. Capital gain tax. Capital gain tax, they are those taxes imposed on gain arising from disposal of fixed assets. We can call it fixed asset or chargeable assets. According to the Capital Gain Tax Act, it was stated clearly as chargeable assets. And chargeable asset means fixed asset. When you dispose any of your fixed asset, you now make a gain. You will pay capital gain tax. Example, you have a land and a land. You buy the land 10 years ago. When you buy the land 10 years ago, you buy it 5 million. You wanted to sell it now. The selling price of that land worth 80 million. The land you buy 10 years ago, 5 million. You now sell it 80 million. 80 million is the sales proceed. 5 million is the cost of acquisition. The difference between the sales proceed and the cost of acquisition is called capital gain. That means 80 minus 5 million. 75 million is the capital gain. And capital gain tax, you will pay a capital gain tax at the rate of 10%. The rate of capital gain tax is 10%. That means out of that 75 million, you are going to pay a capital gain tax of 7.5%, which is 10% of 75 million. That is your CGT. Do you understand? Do you understand?
Yes, sir.
For company income tax, who collect company income tax? Who administer company income tax?
The federal government.
Yes, Federal Inland Revenue Service. Federal Inland Revenue Service. They are the one that collects and administer company income tax. For capital gain tax, who collect capital gain tax? Who impose capital gain tax or administer capital gain tax? In the issue for the capital gain tax, the relevant tax authority for capital gain tax depends on the nature of the transaction. If the person that made that gain is an individual, the capital gain tax will be collected by State Board of Internal Revenue Service. But if the person that made the gain is a company, the capital gain tax will be collected by Federal Inland Revenue Service. Do you understand? Do you understand?
Yes, sir.
So when they ask you who is the relevant tax authority or who administer capital gain tax, you let them know that it depends on the nature of transaction. If the capital gain tax is coming from a sole proprietorship, partnership, individual, trustee, is going to be collected by who?
The state.
The
State
SBIRS.
budget,
Yes.
internal revenue service. But if the capital gain tax is made, the capital gain is made by company, the capital gain tax is going to be collected by who? FIRS.
FIRS.
Still on direct tax. Another type of direct tax that we have is called petroleum profit tax. Petroleum what? Profit tax. Petroleum profit tax is now called hydrocarbon tax. Petroleum profit tax is now called hydrocarbon tax. It is the tax imposed on profit of a company engaged in upstream petroleum operation. You know, petroleum operation is divided into two. We have upstream and what?
Downstream.
Downstream. Upstream has to deal with extraction, drilling, refinery of crude oil. Do you understand? Drilling of crude oil, extraction of crude oil, refinery of crude oil. That is after upstream. Example of such company engaged in upstream: Shell Petroleum Company, Chevron, Mobil. Downstream has to do with transportation of refinery product and distribution of that refinery products to the consumer. All those filling stations that we have, they are downstream. Downstream petroleum company pay company income tax, while upstream petroleum company pay hydrocarbon tax. They don't pay company income tax. So petroleum profit tax, which is now known as hydrocarbon tax, only apply to upstream petroleum company. Those companies engage in extraction, drilling, refinery of crude oil. From the profit that they derive from such kind of business, they will pay hydrocarbon tax, which is called petroleum profit tax. But all those companies that deal with filling station, that has a filling station, they are not expected to pay hydrocarbon tax. They are expected to pay company income tax. They are downstream. So that is it on hydrocarbon tax, which is petroleum profit tax. Another type of direct tax. Let's look at another type of direct tax. Education tax. Education tax. Education tax is a tax imposed on profit or unadjusted profit of every company in Nigeria. And that education tax, government collects it. Education tax is collected by FRS on behalf of government. And once FRS collect the education tax, they will remit the education tax to a body called TED Fund, Tertiary Education Trust Fund. They call them TED Fund. TED Fund will use the education tax to construct buildings, classrooms, research room, award scholarship to lecturer in public tertiary institutions like universities, polytechnic, and college of education. Hope you understand my point. So education tax is paid by all companies, either petroleum company or any company. They must pay education tax, and they pay it based on their adjusted profit. Who collect education tax? Federal Inland Revenue. Once Federal Inland Revenue collect education tax, they will remit it to a body called TED Fund, and that body will use it to construct buildings in public institution, public university, public polytechnic, public college of education. What is the rate of education tax? Presently, the rate of education tax is 3%. The rate of education tax is 3%. Year of assessment. Look at the year of assessment. As our 2019 year of assessment, education tax rate is 2%. 2020, 2%. 2021, 2%. In 2022 year of assessment, education tax rates turned to 3%. 2.5%, sorry. In 2024 year of assessment, education tax rate moved from 2.5% to 3%. So as at present, the present rate of education tax is what? 3%. But in an exam, if you are given a question that have a year of assessment of 2020, the year of assessment is year 2020, what rate are you going to use for education tax?
2%.
What of if the year of assessment is 2022?
2.5%.
So please, you need to know that. You need to know that there are some questions in an exam. You'll be asked to use 2%. Some question you'll be asked to use 2.5. Some question you'll be asked to use 3%. It depends on the year given to you in an exam. Do you understand my point?
Yes, sir.
Okay. Now, we are still on direct tax. Another type of direct tax that we have is called technology tax. Technology tax. Technology tax is otherwise called NICDA. Technology tax is otherwise called NICDA. NICDA. This technology tax was introduced, I think, in the year 2010. And it is a tax imposed on profit before tax of some specified company. This technology tax is also imposed by FRS. It is imposed or administered by FRS, Federal Inland Revenue Service. But it is not every company that pays technology tax. We have the list of selected companies that paid technology tax. What are the list of companies that pay technology tax? Number one, telecommunication company. Companies that fall under telecommunications, like MTN, Airtel, Glo, Globalcom, they pay technology tax. Internet service provider, Remita, which other internet service provider do we have? Payment service provider. Insurance companies to pay education tax. Banks pay education tax, pay technology tax. So we have the list of industry which the company can pay technology tax. Number one, telecommunication company, banks, internet service provider, insurance company. We also have payment service solution company. All this like Remita, unified payment system. So most of the companies that make use of technology, once FRS collects technology tax, FRS will remit the technology tax to a body called NICDA. This body is called National Information Technology Development Fund. They are using this technology tax to develop information technology in Nigeria. What is the rate of technology tax? The rate of technology tax is at 1% of profit before tax. Do we understand? Do we understand?
I have a question, sir.
Okay.
So, reading this, it also shows that it's for companies whose income is above 100 million naira. Does it mean even if
yes,
they're a communication company and they don't pay that yet until
in a particular year, if the company turnover is not more than 100 million naira, they will not pay technology tax. Assuming MTN now, in a particular year, their turnover is no more than 100 million. That means they will not pay education tax. The condition for such company paying education tax is their turnover must more than 100 million naira. Do we understand?
Yes, sir.
Do we
Thank
understand?
you.
Okay. So we have done with direct tax. We have done with direct tax. We should move to indirect tax. We are still under classification of tax according to incident. Indirect tax, like we say, there are those taxes imposed on goods and services. And indirect tax is borne by the final consumer. Type of indirect tax. What are the type of indirect tax that we have? Number one, custom duties. Custom duty, they are the duties imposed by Nigeria Customs Services on imported products, on some specified or some listed imported products. Aside from that, we have excise duties. There are some goods manufactured within the country that they pay excise duties on them. Such good too is an indirect, such type of tax too is an indirect tax. Another type of direct tax, indirect tax that we have is the most common one, value added tax. Value added tax. Value added tax. Value added tax is an indirect tax imposed on consumption of goods and services, and it is borne by the final consumer. Value added tax is charged at the rate of what? 7.5%. And it is collected by Federal Inland Revenue Service. Another type of indirect tax is called stamp duties. Stamp what? Duties. Stamp duties, they are the duties or levy imposed on a document so that such document can serve as a legal binding. So it will make that document to be a legal binding. Those duties or taxes imposed on a written document or transaction to make such transaction a legal binding. That is called stamp duties. Example of stamp duty: electronic transfer levy. That 50 naira charged by bank for a transaction above 10,000 naira is a stamp duty. Such transaction, it will make the transaction to be a legal binding. So that transaction can be used as an evidence in the court of law once you pay stamp duties on them. So those are the type of indirect tax that we have. Now, let's look at summary of classification of taxation. Number one type of tax that we have, personal income tax. Who is liable to pay personal income tax? What type of income does personal income tax liable to? Income from employment, income from business, income from investment. Who is liable to pay personal income tax? Like I stated, individual, employee, sole trader, partnership, estate, trustee. Who collect or who administer personal income tax? State Board of Internal Revenue Service. So I gave out the summary. I did the summary of each type of tax one by one for our better understanding. Now, let's go to principles of taxation. That will be our last lecture for today. Principles of taxation. Principles of taxation is otherwise known as canon of taxation. Principles of taxation is otherwise known as canon of taxation. They are the attribute of a good tax system. They are the attribute of a good tax system. So let's look at those principles one by one. Number one is principles of conveniency. Principles of conveniency. A good tax system should be based on ability to pay. Conveniency is saying that the method of payment of tax and time of tax collection, the convenient tax payment. Conveniency is saying that a taxpayer should not experience a stress while paying tax. Tax should be paid easily. Like 4 years ago, tax is not convenience. If you want to pay tax, you have to go to bank. like 4 years ago, there is no tax promise. If you want to pay any tax, you go to bank. Bank will generate a code for you. They will help you pay. Sometimes if you go to bank will delay you. Bank can say the network is not going. Bank will even say internet is down. Wasting of time. But right now, as I'm talking to you, if I want to pay any type of tax, I can pay it through tax promise. I will just log in the tax promise, the company tax promise profile, and I will pay. Technology has really aided tax to be more convenient. Time of tax collection should be convenient. Tax should be collected after the end of the transaction. Take, for instance, your personal income tax. How does company pay personal income tax? When does company pay personal income tax? When does company pay personal income tax? Personal income tax is paid on 10th of the following month. That means personal income tax for December salary must be paid on or before 10th of January. That means it's convenient. It is after the employee collects salary, government will come and ask personal income tax on that salary. You cannot say before the employee collect the salary, they should pay personal income tax on the salary. No. That is principles of conveniency. Another principle we should look at, principles of simplicity. Principles of what? Simplicity. A good tax system should not be complex. A good tax system should be written in a straightforward language, simple language. It should be easy to administer, clear and well understand language. When you are writing anything on tax, don't be using BB grammar. We are not eating grammar in tax. What we are after is how do we collect tax? So if you want to send, as a tax authority, if you want to send a message to taxpayer, write the message in a simple and understand manner. Ensure that each of the taxpayer understand the language you use to communicate to them. In adherence to principles of simplicity, if FRS want to make a publication, they have to make the publication in English. They will make the publication in Yoruba language. They will make it in Igbo language. They will also make it in Hausa language, so that people cannot prove that they are ignorance of law. Hope my explanation is clear.
Yes, sir.
That is principles of simplicity. Another one, principles of economy. Principles of what? Economy. This one is saying that the cost incurred by the tax authority in administering tax should not be more than actual revenue generated from the tax. This one is addressing is referring to the tax authority. You should not spend more costs in collecting tax. The cost you are spending in collecting tax should not be more than the actual tax collected. Can you imagine? In 2021, FRS, I'm just using as an example, maybe as it's just an example. In 2021, FRS spent maybe 10 billion. They now realize it. So that is piece of economy. Another principle that we have is called principle of equity. Principles of what? Equity. This one is referring that a good tax system should be fair. There should be fairness, unbiased treatment of all taxpayers. When tax authority is dealing with the taxpayer, they should deal with them with fairness, unbiased. Every taxpayer should be treated in an equal manner. You should not treat them based on their religion or based on their tribe. You should not say because this one is coming from the north, you should pay lower tax than the south. You should not say because this one is a Muslim, you should pay lower tax than Christian. No. There should not be bias in tax collection. Every taxpayer should be treated in a fairness and reasonable manners. Do we understand? Do we understand?
Yes, sir.
Another principles of certainty. Certainty simply means the method used by the tax authority to compute tax to be paid should be clear to the taxpayer. Tax should not be ambiguous. It should not be rigid. It should not be something that people cannot understand. The method used in computing the tax should be clear to the taxpayer. We have another one, principles of flexibility. Principles of what? Flexibility. This one is saying that a good tax system should change based on the changes in circumstances in the country. Tax should not be rigid. Tax should be dynamic. Tax should change as there is changes in circumstances. In some time, the economy will boom. When the economy is booming, what will government do? They will impose more tax, Abi. But when we are in the economy recession, business is not doing well, government should reduce the rate of tax. Tax should be based on changes in circumstances of the country. So those are the principles of taxation that we have. We have principles of equity, principles of certainty, principles of conveniency, principles of flexibility, principles of simplicity, principles of economy. Those are the canon of taxation. It's also called principles of taxation. Do we have any question? Any question, any query? Any question, any query? So, in the absence of no question, today being the first day of the lecture, because for the sake of for the sake of the student that will join us next week, so let's try to stop here so that those who are joining us next week too can have one or two things to benefit. So by next week, we still talk about introduction to tax, and in that introduction to tax, we start from tax system. Tax system. When we discuss tax system, we discuss element of tax system. By next week too, we are going to discuss tax clearance certificate, tax identification number, problems of taxation by next week. Any question, any issue, any observation?
No, sir.
Yeah. Do you want to ask a question?
No, yet.
Okay. So in the absence of no question, thank you for having me. Have a good day. So I will send the lecture material, updated lecture material to you. So thank you. Have a nice day.
All right. Thank you very much, sir. Bye, sir.
Thank you, sir. Thank you, sir.
Yeah.
Thank you, sir.